A very good morning to you. Thank you very much for watching KBC Channel 1. This is BizCheck. My name is Betty Kiptum and Byron Abuli is my colleague on the sign language interpretation. Over the next 2 hours, we shall be having conversations on matters money as well as farming. The first conversation is the 2025 economic or other investment outlook, and we shall be talking to Ronnie Choka, who is the senior research analyst at Capital A Investment Bank. That conversation is the first one. The second one, we shall be discussing pig farming. As a pig farmer, what do you need to do to ensure that you thrive in your trade? And now we get into that first conversation on matters the 2025 investment outlook. Ronnie, thank you very much for joining me.
It's a pleasure to be on your show.
Karibu sana.
Thank you.
Right, we can start with the global situation first of all. Let's discuss 2024. And the global growth, it's steadied at 3.3%, or rather you expect it to be at 3.3% in 2025. How was 2024 like?
I think to contextualize 2024, I think there are very few years where we've seen as high volatility as we did in 2024. For instance, Kenya, for example, oscillated from the worst performing equities market in the sub-Saharan Africa space to the best performing market in 2024 in USD terms. That's just to show you the volatility across the market. Not only that, even in the fixed income space, we saw treasury yields oscillate by as high as 6% up and then down by the end of the year. So last year was very volatile. Furthermore, globally, we came in from a regime at the start of 2024 where interest rates were very high, interest rates were very tight. Inflation was also at multi-decade highs across the world. Geopolitical tensions were also high, given that the legacy effects of the Russia-Ukraine conflict and later on the Middle East tensions also rose about. It was in that context where we also had a historic wave of elections across the world, which promised a host of changes in diplomatic relations and also trade policies. And now stepping into 2025, or as we came to the end of 2024, what we saw was inflation cool down to single-digit levels across the world. That was an encouraging sign. Even key central banks now had the legroom to lower interest rates. Even funneling closer home, we saw our central bank now lowering interest rates in the latest iteration to 10.75%.
Right. So as we now come closer home, the sub-Saharan Africa region, you mentioned the Kenya shilling appreciating, it appreciated 17.4% against the dollar, the strongest performance in the year. Nigeria was the worst. Ghana and Egypt also had problems there. So for sub-Saharan Africa, 3.8% growth last year, you're projecting 4.2%. What will be driving this?
Okay, that growth projection is usually derived from the International Monetary Fund, the World Economic Outlook published in January this year, whereby they cited that in the sub-Saharan Africa region, we are noticing a wave of stability, so to say. Compared to 2023, we had conflicts in the Sudan region and the Chad region. I know the conflicts in the Sudan region are yet to be concluded, but at the moment, we can say we are at a better footing on average. We've seen East Africa region growth hold up relatively well, and so was this growth in the South Africa region. However, if we look at West Africa, growth was a bit muted, owing to the very high inflation rates. For instance, Nigeria, in Ghana, we've seen devaluations of their respective currencies, which has resulted in imported inflation. The kind of which we also saw in our home scenario, I think back in 2022, 2023, when the exchange rate had depreciated almost to a peak of around 160. At that time, inflation was heading into the strong double digits. But thankfully, for the Kenya case, we were able to navigate our exchange rate back to stability. Our balance of payment position was enhanced. Our forex reserves position lifted to $9.2 billion, which is more than enough to cover 4 months of import cover. So all in all, I think the outlook for the Sub-Saharan Africa region is pegged on lower interest rates, which will stimulate private sector investment spending. We're seeing recovering consumer demand, meaning we are phasing out the legacy effects of the coronavirus pandemic.
Mm-hmm. Yes. The 17.4% rise of the Kenya shilling, what drove that? And are we going to see, or rather, what do you foresee for this year in terms of the Kenya shilling performance?
Okay, our exchange rate outlook is rather conservative. We think the exchange rate will remain stable until the end of the year. We've seen an improvement in macroeconomic indicators from inflation. Inflation has really cooled down or softened to the latest metric coming at 3%. We've seen also our forex reserves position has really solidified. We were trailing below the 4 months of import cover necessary. However, right now we are above that. Imports are now recovering, and the nature of imports is also something we also look at. We are now noticing a rise in capital expenditures on machinery and equipment, which is a good thing because now it shows businesses are optimistic on consumer demand. Now that interest rates are coming down, it's even all the more better, since we'll see now banks extending more credit to the private sector. It is envisioned that banks will extend that same benefit of lower interest rates to consumers. Yeah.
The Kenyan economy, it slowed in 2024 to about 4.5%.
Yes.
How did we get to that number?
So last year, growth was plagued by a number of challenges. Number one, inflation was very high. So prices were skyrocketing on a year-on-year perspective, which presented a number of challenges. Firstly, consumer demand was challenged. Consumers had to now reprioritize their spending to necessities only, meaning other sectors such as tourism and even manufacturing came under pressure. We saw, according to the PMI reports by Stanbic Bank Kenya, we've seen businesses accumulate on inventory which are not, turning over. So that was a very big challenge for businesses. A number of businesses shut down, as you are well aware. Another thing we saw is that demand was largely challenged by, the uncertainty. Even if you look at the CEO surveys by the Central Bank of Kenya, inflation expectations in the future were also as high. It did not help either that interest rates were also very tight. We saw banks lending as high as 27% per annum, which is very, very tight to serve. Very few businesses can deliver such a return to service the interest and still make profits. So generally, economic activity slowed down. There was extensive crowding out of the private sector, given that government was borrowing heavily from the investment space. So we saw government even borrow as high as 18%. So if banks are given an investment of 18% risk-free, what's the incentive to lend to the private sector? So that was a big challenge. Hopefully, thankfully, to the Central Bank of Kenya's credit, that situation has been reversed. And now we are waiting for the funnel through effects in the form of lower interest rates. We think that should stimulate growth going forward, especially for the manufacturing sector, which was almost grinding to a halt, with growth coming at 0.6% in Q3 last year.
Of course, you've mentioned manufacturing. Another strong sector is the agriculture as well as the services industry. They are quite some supporters of the Kenyan economy. And these were still in the red, right?
Yes, growth slowed down generally across all sectors. Agriculture slowed down, and so did services. Manufacturing was the most notable slowdown. We grew by the slowest pace, not only here at home, but regionally. In East Africa, manufacturing is really slowing down. Its contribution to GDP is also shrinking to now as of 2024, that contribution shrunk to 7%. We were as high as 15% 5 years ago, contribution to GDP, but now that has shrunk progressively to 7%. But on the flip side, services contribution has really grown. It employs the largest percentage of Kenyans. And for instance, we're seeing bright prospects in the tourism sector, where domestic tourism is now coming to the forefront. As per the latest statistics by the Kenya National Bureau of Statistics, we are seeing the highest contribution to tourism, or let's say domestic hotel bookings, is coming from domestic tourists and not from foreign tourists, which is now a good sign, meaning our industry is coming of age. We don't need to rely externally now so much for our tourism growth. And it can only get better from here.
Right, yes. And of course that is one of the positive lessons that the industry took from COVID-19 when they had to adjust and start depending on the domestic tourists, right?
Precisely.
Right. The issue of the dip in manufacturing, let's just stay there a little bit. Does it mean that we are not consuming locally? What is driving this dip?
So there are a number of factors. I'm looking at it two ways. On the demand side,
right.
Consumers are reprioritizing spending, or have been reprioritizing their spending to necessities. So meaning spending on non-essential goods, or what may be perceived as luxury items by most households, has dwindled. And it's a function of the real incomes. Nominal wages have stagnated, while inflation has been eating up into the real purchasing power of Kenyans. So that has meant, for now the manufacturing companies, slower and slower growth in revenues, given that demand has been challenged. On the supply side, manufacturers have been facing or contending with inflationary pressures as well. On the raw materials they require for their production, their prices have been soaring as well, across all industries. And that also now presents a challenge. It eats into their profit margins, as you can imagine. So on the top line, you have slowing revenues, and on the cost side, you have rising costs. So your margin function has been shrinking over and over until some businesses are basically wiped out. Small and medium-sized businesses have come under a lot of pressure. Actually, it's only large cap or large-sized businesses that have emerged unscathed relatively from the COVID era to now. Yeah.
So it has been a very tough time for SMEs.
It has been a very tough 5 years since 2019. However, we are seeing bright prospects from here. We're seeing signs of recovery. Now that inflation is coming down, we expect now that benefit to trickle to consumers, in the sense that their purchasing power will improve relatively. We'll start seeing them demanding more and more goods. Tourism will again continue to grow by a stronger rate domestically. And even now, given our positioning globally, Kenya has been marketed as a very attractive tourist destination. So that is also another benefit we need to leverage on to propel ourselves forward. Agriculture, on the agriculture front, we've seen slower growth as compared to 2023. Last year, in as much as we didn't have a drought, we didn't have super normal, or above average weather conditions to stimulate the growth in output that we did in 2023. However, and also, when we consider the fact that the exchange rate appreciated in 2024, that meant exporting farms only received much lower earnings from their sales, now given that the exchange rate had appreciated. So it's a function of also the global markets, given it's highly competitive. And, there's a very strong hypothesis that usually states that the contribution of developing countries to the global output in value terms shrinks as compared to countries, let's say in developed economies, which are able to add value to the agricultural output. So they have a higher pricing power. They command a bigger share of the global, let's say, coffee output value compared to, let's say, Kenya, which only, exports raw coffee beans with only minimal value added. So we find we don't have a stronger pricing power because now we are competing with Brazil, we are competing with India, which are also mega producers of the same output. So it's a highly competitive space, low pricing power, meaning you can only increase your earnings by growing your output. As compared to developed economies who by adding value to their output are then able to command higher prices and thereby command a higher total output from the whole value chain.
And why can't Kenya do that? I mean, it's 2025. Why are we not adding value to our produce as opposed to just exporting raw material?
So it's been a subject of continuous debate, even in the academic circles. We should basically, it's the intuitive solution, to basically build capacity, the necessary capital expenditure, so that we are able to add value to our exports. And that's a continuous debate. We've seen the government also strengthen the package of incentives to export processing zones, including tax exemptions, so that they're able to make the necessary investments in machinery and equipment to add value. But it's gonna take time, because now, even as we grow our technology function, even developed countries are also strengthening their value proposition, their automation, and it's a race against time, really. What will be the defining factor, in my view, has to be the level to which we are able to speed up or intensify. In fact, it should be a policy priority for the National Treasury to really strengthen our value proposition insofar as value addition to our agricultural output is concerned.
Right. Let's spend a little time on inflation. Headline inflation eased from 7.7% in 2023, that's an average, to 4.5% in 2024. Core inflation, there was a slight decrease from 3.9% to 3.5%. Let's start here. What is the difference between headline inflation and core inflation?
Great. So maybe I can start with core inflation.
Right.
So core inflation measures the changes in prices of items such as, the cost you pay for, let's say, this glass of water, these spectacles today versus a year ago, It measures changes in prices of services as well, the cost of taking a taxi, for example, and so on and so on, except now for food items and fuel items, which tend to be more volatile. Those ones are measured separately from the core inflation. So core inflation tracks the changes in prices of goods and services, with the exception of food and fuel, whereas now the non-core inflation, which has been, rebased, or let's say revised in January this year by the KNBS, now that tracks the changes in prices of food and fuel items, which are more volatile, and food also comprises the highest percentage of the CPI basket. So that's the major difference between those two inflationary metrics. And just to comment on the trends, we've seen now headline inflation coming down. Headline inflation is now the average of the two. It's the average of the non-core inflation and the core inflation, which has been on the downtrend. And we credit this to, firstly, we've seen a rebound in food supplies. We are no longer importing as much food as we did in 2023, which is a subject that the central bank governor commented on in the latest MPC iteration. We've also seen fuel prices come a bit lower compared to last year. For instance, petrol was retailing as high as 195 last year. This year, we've seen it have averaged down to around 176, 177 for petroleum. That reflects the general trend for petroleum products, including gas as well, which now we do anticipate will sustain at that level. Now that the exchange rate has stabilized, we do not anticipate that there will be other disruptions other than geopolitics that can upset the inflation picture. So we expect inflation to average at around 4 to 4.5% this year. Yes.
When you say inflation has come down, generally people assume prices have come down. That is what people assume, right?
Yes.
But the reality is different, right?
Yes. So when you talk of inflation slowing down, it does not mean prices have necessarily come down. What it may imply is that it's only the pace at which prices are rising has slowed down. Yeah. The other aspect you're referring to, where prices decline, is called a deflation.
Right.
Deflation, and it has actually happened in January. Now, for fuel, we saw a deflation in prices. Yeah. So, but when we do the weighted average of all products in the CPI basket, including food, we saw a mild inflation of 3%. Yes.
Right. And what are you foreseeing for this year in terms of inflation, considering that last year there was a lot of weakened consumer demand?
Yes.
Yeah.
So this year, our inflation outlook on the external front, insofar as the imports we rely on, the fact that the exchange rate has been stable over the past 6 months and running implies that the cost at which we import our machinery, our textiles, and so on, is expected to remain stable. So that should allow for predictable planning by businesses insofar as importing the goods and services are concerned. They can now extend even the benefit of lower, basically stable margins, and now that will imply fixed, stable and predictable prices to consumers as a result. As compared to the scenario last year when the exchange rate was weakening every week. You see the weakening, the exchange rate losing as high as 1% every week. That was very volatile. Businesses were, on their heels, having to revalue their goods upwards every week as well to keep up with the changing dynamics. And that is really bad for a business environment, because if consumers also can't have the certainty that I'll purchase the same loaf of bread tomorrow as I did yesterday, that upsets the whole economy, in terms of both businesses and consumers. Stability is really good. I usually say consumer confidence is even worth much more than money itself.
Right. You've mentioned consumer confidence. A lot of times people go shopping and they're like, just look at what I bought for 1,000. This could have been maybe double the size last year or 2 years ago. So for this year, do you think that consumer demand is going to rise?
There are a number of factors to this.
Yeah.
For one, we have to look at the wage function. Nominal wages have been growing very slowly, an average of 6% last year. Nominal wages on average. When you look at inflation, on the other hand, that one has been decelerating, which is a good sign. That means now when we look at the real purchasing power, after we deflate, or after we filter out inflation effects, that would mean the real purchasing power is slowly improving. That should mean if that trend persists, consumers should start feeling, the wealth effect. Money is, increasing in their pockets. But you need many more consecutive quarters of stability, like 4 consecutive quarters of stability in prices for consumers to start feeling the wealth effect and now be confident to spend more out of their disposable incomes. However, for the time being, whereby nominal wages or the per capita incomes have been growing, albeit very slowly, we think it will take a very long time for consumer confidence to pick up to the strength it did in the decade of 2010s to 2020.
So how is that going to impact businesses?
So for businesses, it depends on the industry, but the general trend, we think businesses will have to keep their overheads low, if at all they are to remain in business. This is because consumer demand isn't projected to pick up strongly, at least not for in the short term. There's still uncertainties in the geopolitical space, which are also a factor to consider. Crude oil can, oscillate as much as it did in 2022, which can present additional headwinds to consumer spending power. But to the extent now the global economy is also stabilizing, interest rates are coming down, I think we are easing into a recovery. We can now say with growing confidence, we are seeing, we can say with more confidence that we are phasing away the legacy effects of the COVID pandemic. We are seeing an improvement even in the capital markets. Equity turnover is really soaring to, for the first time in around 6 years of consecutive decline. Even investor optimism, as signaled by the market indices and also the price to earnings ratio of the NSE, they are signaling investor optimism. You're signaling a renewed outlook of improved performance for corporates, but we think it will take slightly longer. That's why in our growth outlook, we've kept our forecast low. We forecast GDP to grow at 4.4% in 2025. And the other factor, in as much as interest rates are coming down by the CBK, we've seen banks also, hesitate to lower the same rates or extend the same benefits to consumers. The central bank governor iterated that there'll be even punitive measures for banks who do not comply with the directive to lower interest rates. But this comes in a context where non-performing loan ratios in our market are in the strong double digits, averaging at 16% last year. Now, to compensate for that risk, on the commercial banks' perspective, they have to compensate for that risk through higher pricing of interest rates. That's why in their risk-based pricing models, riskier borrowers are charged higher compared to the less risky borrowers. So that is also a dynamic that the central bank has to navigate. It's not necessarily true that because you've lowered, let's say, the cash reserve requirement for banks, that banks will extend the same credit to the private sector. Because what the trend we're looking at in the capital markets is that we're seeing domestic borrowing is even growing by the day. You've seen supplementary budget 2 estimates which project increased borrowing to 862 billion shillings in this fiscal year. And when you take cognizance of the fact that, there's the extensive crowding out effect when government borrows more from the private sector, it can only be expected then that banks will continue to be very cautious in lending to the private sector. They wouldn't want to take up on excessive risk in such an environment where consumer demand is not where it was prior to the pandemic. Yes.
Yeah, so when you mentioned the issue of banks and the CBK on matters rates,
yes.
Once CBK was like, there'll be some punitive measures here, some banks released that, they've lowered the rates by this much. but plus the risk part of it, and they were not capping that, so it could still be high, right? And you do understand why banks are behaving like that.
Yes.
Yeah. Right. Now let's talk about geopolitical environment. Last year there were a lot of elections across the world, and one of the biggest changes was in the US. Now there's a new president, Donald Trump, and he has come in with very protectionist policies, tariffs left, right, and center. And how is this going to impact our markets? How is it going to impact us? You know, you might be hearing about tariffs somewhere in Canada and US, but how is it going to impact Kenya?
Okay, so insofar as geopolitics is concerned, we've seen sweeping changes in not only the regimes, but even now the political philosophies they embody now mean there are gonna be clashes with other global factions. And you're seeing that materialize and continue to take shape in 2025. As you rightly point out, with the Trump 2.0, we're seeing tariffs now emerge more strongly. And, it's the games of global trade in the sense that, all countries would consider it in their best interest to maximize the most gains from trade compared to other countries. And that's the philosophy Trump is taking on. When they look at their trade balances, let's say with the European Union, they are noticing negative trade balances, meaning the Eurozone has been benefiting more from the trade interactions with the US. So Trump is looking to reverse that by, levying tariffs. They look to strengthen their domestic farms. Their ability to export at higher prices would mean higher even tax revenues for themselves and even for US corporates. And you can't argue with the ideology. It is economically rational. However, that clashes with the mainstream or let's say the contemporary global trade philosophy of globalization. When you levy more and more trade tariffs, you are increasing the barriers to trade, which in effect lowers the overall trade volumes. So the World Trade Organization has been understandably against that policy of higher tariffs because it tends to trigger retaliatory responses. So you get into this vicious cycle of, because you added tariffs to our exports, we are also levying tariffs on your exports as well. So it's a back and forth that tends to get into a very ugly level, if not unchecked. Yeah.
We saw when Russia-Ukraine happened, or when it started, because it's still ongoing.
Yes.
There were a lot of sanctions against Russia and all that, but somehow they still had some level of economic growth, over the past years. Do you think that US can self-sustain, so to say?
By and large, the diversity within the US economy itself is very, very strong. In fact, the contribution of global trade to the US's GDP is very minimal. They can very well self-sustain. Their oil reserves are very strong. They can, it's said that their oil reserves are enough to cover them for the next 100 years on the minimum. So that diversity in itself is a strength, whereby they wouldn't really suffer were they locked out from global trade or were they to operate in autarky, as we say. But we still need trade. We know countries can benefit from trade even if they don't have an absolute advantage in producing those goods. For instance, it is said developing economies like Kenya have a comparative advantage in, raw output, agricultural output like tea, coffee, and so on. We are more efficient cost-wise in that sector compared to developed economies. Who are more efficient in production of machinery, So we can both mutually benefit from trading with each other as compared to, autarky. We live by ourselves and they live isolated by themselves.
Right. And so how is this going to impact Kenya? Are we going to feel the effect of these tariffs as well?
What our outlook is that, for one, we are seeing the proposal to increase tariffs as high as 60% to Chinese exports and 25% to the rest of the world. That certainly upsets the global inflation picture in the sense that our global trade is projected to decline. Now that prices are going to be higher, intuitively, demand will take a dent. That may also affect supply chain disruptions, especially if China retaliates again with the same countermeasure, let's say even a 50% tariffs on US exports as well. That would mean now if that Chinese goods, which we import a lot as a nation in Kenya, will become more expensive. That now would mean now these commodities we rely on, including textiles, plastics, and so on, will become more expensive to the Kenyan citizens. And consequently, the inflation cycle will now start rising, as opposed to how it is now, where it is, stabilizing at 3%. Yeah.
All the more reason to grow our own manufacturing sector, right?
All the more reason.
Right. So for the next 5 minutes or so, let's talk about Kenya's fiscal policy. We know that there was the introduction of the, one line of channeling all the government monies to. How did this impact the revenue collection last year?
All right. We've seen a decent improvement, actually, in tax collections as a result of the Treasury single account policy. We've seen appropriations in aid really grow by as high as 12% year on year. Now, we are projecting to collect 484 billion in through appropriations in aid alone.
Right.
Compared to the initial target of 420. So there is some benefit to the Treasury single account, and we can only hope the fiscal responsibility principles will remain true. And also noticing on the ordinary revenue front, we've noticed an average double-digit growth. Last year, revenues grew by 11% to now crossing the 2 trillion mark, which is a good sign. In as much as imports last year were, slowing down, meaning custom duty collections were, challenged. This year we are seeing a recovery in imports as well. On the export side, it's a function of competition, so we can't really raise our exports as much as we would wish to, unless now we add value to our exports. But insofar as our fiscal basket is concerned, we've seen promising growth. However, that same growth in revenues has been matched with even higher growth in recurrent expenditure, which almost now negates the collections, because now we'd expect now at least maintain spending constant, such that our fiscal deficit would be shrinking over time. Now we are projecting an expansion or a widening of the fiscal deficit to 4.9% of GDP in the 2024-2025 fiscal year, which now is at headwinds with not only our own thresholds, where we intend to minimize it to 3%. It also clashes with our debt covenants, for instance, with the IMF, whereby we want to lower our debt to GDP ratio to 55%. But now we are heading closer to 64% of GDP in present value terms. Yeah.
So we are looking at a 4.2 trillion shilling budget thereabout for this year, according to what Treasury has been saying in the past few months. How is Kenya going to tame to find a balance, you know, between the revenue collection, because a lot of individuals, especially salaried individuals, feel like you know, they're really at the end of it. Businesses, as you said, majority who are SMEs are also struggling in that way. So how are we going to find a balance?
So at present, what you're seeing from the Treasury side, they are now on a policy of stimulating economic growth, because they've noticed private sector lending has really dwindled to even a negative growth, meaning commercial banks have not been lending to the private sector as the government would wish them to. So, which is why now the Central Bank of Kenya has also been on a policy of lowering interest rates, signaling to commercial banks that, hey, right now, the economy, we've now settled the inflation front. Inflation has now cooled down. Now let's focus on the economy. Let's stimulate employment, raise the per capita income overall. And that now is what informs their policy of lowering interest rates and instructing central banks also to extend the same benefits to consumers. And added to that, they've increased the cash reserve requirement, or rather they've lowered the cash reserve requirement so that in effect, banks have more liquidity to lend to the private sector. That means hundreds of billions in Kenya shillings available for private sector borrowing. If that policy is to funnel through to its logical conclusion, then we should have a decent spurring in consumer demand. Businesses will have more confidence to, because it's usually a chain that trickles over and over, turns over and over until we have now the economic engines running, you know?
Right. So as we come to a close of the conversation, what would be your message to investors who are looking to invest in Kenya? Let's start with people who are looking to bring money in, and domestic investors who are looking for a place to put in their money.
Okay. So to investors looking to invest in Kenya, I think we are seeing promising signs of growth. Inflation has cooled down, as I've pointed out. Interest rates are also coming down, meaning you can borrow at favorable rates and invest. We've seen consumer demand slowly pick up. They're seeing signs of promise. We can confidently say we've phased out the COVID-19 effects. The exchange rate has been stable for the last 8 months and counting, and we expect it to remain stable until the end of the year. So I think the time we have all the conditions favorable to, you know, get the economic renaissance or revival that we've been waiting for. Exchange rate stability is actually very important for even foreign and even domestic investors. If you consider countries such as Nigeria, who have devalued their currency twice, in 2022, the exchange rate was around 400 naira to the dollar. Right now, we are looking at 1,600. That's a 40 times slide.
Yeah.
You can only imagine how prices have been disrupted. You have the prospect of buying something 40 times more than you did last year is just mind-blowing.
Right.
So that use case I've cited is for us to appreciate how much of exchange rate stability is important for businesses and consumers alike, and even in terms of forward planning.
Right. Yeah. Thank you very much, Ronnie. That is where we end the conversation. Asante sana for sharing your thoughts with us.
Thank you so much.
I have been speaking with Ronnie Choka, who is a senior research analyst at Capital A Investment Bank. We've been looking at the 2025 investment outlook, how 2024 was, and how this year is expected to be. This is BizCheck. We want to take a quick break. When we come back, we shall be talking about pig farming. Do stay with us.